The global fixed income market is the bedrock of our financial system. It is a vast ocean of debt where governments, corporations, individuals lend and borrow money. For decades, this market seemed unshakable. Savers bought bonds to preserve their capital and earn a predictable income. Governments issued bonds to fund their operations. This system was built on trust and stability. But today, deep cracks are appearing in this foundation. The old world of bonds is under immense and growing strain. The rules that governed this world for generations are starting to break down under the weight of unprecedented economic pressures. This is what happens when governments and central banks intentionally keep interest rates artificially low. They do this to make their own massive debts more manageable. When rates are low, borrowing is cheap. This is good for the borrower, but it is devastating for the saver. If the interest rate you earn on a bond is lower than the rate of inflation, your money is losing purchasing power every single day. You are being taxed silently. Your capital is being eroded. This quiet transfer of wealth from savers to debtors is a fundamental violation of the principles of sound money. This situation forces savers into a difficult position. The safe assets that once protected their wealth are now guaranteed to lose value over time. The stress in the bond market is not just about low rates, it is also a classic story of supply and demand. On one side, the supply of new government debt is exploding. The United States government is running massive budget deficits, about 7 to 8% of GDP. To cover it, it must issue trillions in new bonds every year. New supply pushes bond prices down and yields up. The government needs more buyers to absorb all this paper. That's becoming harder. Historically, much of this debt was bought by foreign governments and central banks. China, Japan, oil exporting nations. They recycled surpluses into U.S. treasuries as the safest, most liquid asset. That demand was reliable, but now it's reversing. The foreign share of U.S. public debt fell from nearly half in 2011 to less than a third by 2025. In the face of a failing fixed income system, a new solution is emerging. It is called digital credit. This is not just another financial product, it is a fundamental rethinking of how credit works. Traditional credit is based on a promise. A government, a corporation, promises to pay you back in the future, with interest. This promise is backed by their future ability to tax or generate revenue. Digital credit is different. It is not based on a promise about the future. It is based on a hard asset that exists today. It is built on a foundation of digital property, with Bitcoin as the primary asset. Visual, Bitcoin as layer 1, preferred stock like STRC as layer 2. The concept is simple but powerful. A company holds a large reserve of Bitcoin on its balance sheet. To understand how digital credit works, we can look at a real-world example, the perpetual preferred stock known as STRC or Stretch. Launched in July 2025 by Strategy Inc., STRC was the first exchange-listed credit instrument of its kind issued by a company with a massive Bitcoin treasury. The initial public offering was a stunning success, raising $2.5 billion, becoming the largest preferred stock IPO of the year. This demonstrated a huge and previously untapped demand for a new kind of yield product, one that was not tied to the failing traditional fixed income market. STRC is designed to function as a high-yield, low-volatility income instrument. It pays a monthly dividend to its holders. Crucially, this dividend rate is variable. The company's management can adjust the dividend up or down each month. The primary goal of these adjustments is to maintain the price of STRC at or near its $100 par value. If the price starts to trade significantly above $100, the company can issue new shares into the market. If the price falls below, it can raise the dividend to attract more buyers and push the price back up. This active management framework is key to its stability. One of the most significant advantages of digital credit is its radical transparency and liquidity, especially when compared to the existing private credit market. The private credit market is a massive, multi-trillion-dollar industry where large funds make direct loans to companies, while it offers high yields, opaque, illiquid, inaccessible to most investors. Instruments like STRC are listed on major public stock exchanges. They trade just like any other stock, with deep liquidity and price transparency. Anyone with a brokerage account can buy or sell them instantly, with no lockups and minimal transaction fees. While the potential of digital credit is immense, it is essential to be honest and clear-eyed about the risks and limitations. This is not a risk-free investment. Anyone considering it must understand the trade-offs. The most significant risk is dependence on the price of the underlying collateral. Bitcoin price dependence, discretionary dividend cuts, regulatory uncertainty. The model is built on the foundation of a strong, appreciating digital asset. If Bitcoin's price stagnates for a prolonged period, or if it enters a catastrophic sustained collapse, the system would be severely tested. Falling collateral value shrinks the buffer protecting credit investors. That would put the company's ability to maintain high dividends under pressure. Management can adjust the dividend monthly. The emergence of digital credit is more than just a reaction to the problems in the bond market. It is the beginning of a wholesale transformation of our financial architecture. We are witnessing the construction of a new, multi-layered digital capital stack. This stack is built on a logical progression of risk and return, starting with the most secure and fundamental asset at the base. This new structure has the potential to become a dominant force in global finance, channeling trillions of dollars of capital into a more modern, efficient, and transparent system. At the base of this stack, as Layer 1, is Bitcoin itself, which can be thought of as digital capital. It is the pristine, unencumbered property that serves as the ultimate store of value and the foundation for everything built on top. Holding Bitcoin directly offers the highest potential for long-term appreciation, but it also comes with significant price volatility. This volatility is a form of energy that can be harnessed. The common equity of a Bitcoin treasury company like Strategy absorbs this primary layer of volatility and offers leveraged exposure to the underlying asset. The next layer up, Layer 2, is digital credit. This is where instruments like STRC live. SATA. This layer is engineered to strip out most of the price volatility of the underlying digital capital. It does this by using over-collateralization. Active management. The excess risk and volatility are not eliminated. They are passed down to the common equity holders at Layer 1. In exchange, the digital credit layer offers investors a stable asset with a high predictable yield. It transforms the volatility of Bitcoin into a steady stream of income for those who prioritize stability over maximum appreciation. Looking forward, we can envision a third layer, Layer 3, which could be called digital money. This layer would take the process one step further, stripping out nearly all remaining volatility to create a product that functions like a high-yield savings account. The numbers paint a stark picture of the scale of this problem. In the United States, total government debt has surged past $39 trillion as of early 2026. The annual interest costs on this debt are reaching post-World War II highs as a percentage of the economy. To keep this system afloat, central banks must suppress rates, but this only makes the underlying problem worse. The more debt that is created, the more financial repression is needed to manage it. This creates a vicious cycle that hollows out the value of savings and destabilizes the entire financial system. The traditional bond market is not just strained, it is showing signs of systemic failure. That's the situation we face today. The liquidity of digital credit also creates a powerful flywheel effect. As more capital flows into instruments like STRC, the company can use the proceeds to acquire more Bitcoin collateral.